We're going to start. We're going to start our session, which is called "Powering Virtual Shareholder Communications." I'll just read through, but public companies are navigating uncharted waters with the current uncertainty around coronavirus. The SEC has banned in-person gatherings, forcing shareholder meetings online. How do these challenges actually unlock new opportunities for shareholder communications? Well, I'm fortunate to be joined by Laurent Polac, a entrepreneur, co-founder and executive in financial markets that I've known of for I guess 20 years at this point. I'll give a brief introduction of him and myself before swinging it more in depth to Laurent. But firstly, Laurent, thank you for joining me here.
Thank you for organizing.
Interesting circumstances. So I'm Mark Beeston. I'm the founder and managing partner of Illuminate Financial Management. We are a purely financial markets technology focused venture capital fund, investing from our second fund. We only focus on technology that addresses the challenges of financial markets participants, and we're a pretty heavily networked organization with LPs that include the German exchange group Deutsche Börse and the market data vendor IHS Markit, amongst many others, and industry partners including major banks such as Barclays, ING, and others as well. But we're not here to talk about me. We're here to talk to Laurent. So Laurent is my guest today. As I say, someone I've known in the industry for 20 years. A really interesting character in that he has worked with both the smallest of companies as both a founder and co-founder, as an entrepreneur within those companies through CEO roles. He's had a couple of successful exits in the industry consolidation space, which is an important part of the exit landscape in our space, selling companies to both SunGard and to CME Group. He's served on the executive committees of two major public companies, so he's seen from all the way from the small to the large as a member of the Exco at both ICAP prior to its acquisition by Tullett Prebon and CME Group. And now he's back in the fintech business with Say. So Laurent, thank you again for joining. You're in the virtual shareholder communication business as a fintech, but you didn't start this one. So why don't you perhaps start by giving us a couple more minutes on your own background, and then how come you ended up to be back in the CEO role in fintech land?
Yeah, well, thanks for the intro, and great to speak with you, Mark. Say is it's really a lot of fun to be back in entrepreneurship. The first 15 years of my career, I've been an entrepreneur, starting companies from scratch, raising my first dollar, to actually building and growing businesses and selling them. And then for about 10 years after that, I've been more of an executive in big firms. So being back in entrepreneurship, working for a smaller company that's changing the world with a great vision is a ton of fun. Say is about 3 years old. I was founded by a group of people, including the co-founder of Acorns, Jeff Crittenden, who is actually a co-host here for this event. And the vision of Say is actually quite transformative. The initial idea is actually to give a voice to investors with respect to the companies they own in their portfolio. It's not always easy if you own a stock, Microsoft, Intel, General Motors, or others, to actually understand what are your rights, what are your governance rights, and your ability to engage with these firms. So the vision is really straightforward, is actually to empower shareholders, but broadly speaking, we do a lot more than that. There's a big ecosystem of how corporations communicate with their investors, whether or not it's a retail investor or an institutional investor. That ecosystem is known in our industry as investor communication space. There's a couple of incumbents in that space. Say we are the big disruptor. We actually believe that the way this business has been structured historically and the way corporations communicate with investors and vice versa is quite inefficient, does not really promote the right level of engagement, of dialogue, of transparency. So we're disrupting it by making it a lot more digital, Everything we do is focused on electronic delivery with actually an API-driven strategy and a platform strategy. And we allow millions of investors to be more connected to their investment in multiple forms. Of course, they can receive kind of the ultimate kind of communication from a regulatory perspective that a corporation has to have with their shareholders is to send them a proxy notice, proxy statement, and give them the opportunity to vote on big governance item in the proxy statement on these ballots. So we do that better than anybody. We do it through much more modern use of technology. We deliver it directly in brokerage applications, so it's more consumable, or web apps. And then in addition to that, we also changed the way corporations and investors communicate by creating a channel around big events. So you talked about annual shareholder meetings. We do power a different mode of communication for these type of events. It could also apply, by the way, for earnings calls. We've done that many times, but our technology apply for annual shareholder meetings. So, you know, it's a fun business. It's transformative. It has the benefit of also going after large incumbents that have not evolved that much in the last 20, 30 years, and to really bring a completely different business model and different utilization of technology to an industry that's transforming. So we're very fortunate. We're at the right place at the right time in many ways, and I'll explain to you that in a few minutes, actually. So that's how I got here. It's a small company. It's about 20 people. After 3 years of age, we have a dozen customers. We've actually proven a lot of the key proof points of how to make this business work better with a different model. We have large broker dealers. We service about 1 million investors in the retail space. We've serviced over 100 institutional investors, ranging from the largest to some middle market investors. And then we've done partnership on communication integration with firms like Fidelity.
Okay, well, that's great. I'm going to pick up on something you said there. Perhaps I should start out by pointing out, Illuminate are not an investor in Say. Maybe that's something we need to fix. We can talk about that offline. But you said something that was straight out of my own investment thesis, which was, you know, you're disrupting guys that have been around for 20 years, and Illuminate. We say, you know, we're in a window of generational change. And it's, you know, again, it's driven by the macro environment post the last crisis, never mind this crisis. That's why we actually set the firm up. And then along has come this crisis and really changed everything, again. One of my favorite memes that's been going around over the last few weeks says, who's really driving digitization in your organization? A, the CEO, B, the CTO, or C, COVID-19. It definitely falls into the category of many a true word spoken in jest. But something else that you said there, Laurent, was, you know, being in the right place at the right time. Now, when we talk to our investors and potential investors, and indeed the companies that we're looking to fund, you know, about what's going on in this, you know, incredible change that we've seen over the last, you know, weeks and month to 2 months, you know, it's literally like somebody shuffled the deck, right? If you were a high growth company burning cash when you only had 6 months runway, you know, you probably used to be a top quartile firm, and now you're a top of the bottom quartile firm. And if you did a raise 6 months ago and sat on a load of cash but didn't deliver the growth over the last 6 months, well, you've probably gone from being top of the bottom quartile to bottom of the top. There are, of course, companies out there that are natural winners. Examples not from our portfolio, because I'm not here to promote that. Might include some of the soft turret companies like Cloud9. Anybody that's kind of empowering the new normal of work from home and 100% distributed workforce. Now, you were going after an efficiency opportunity through virtualization, and then this gift has really almost arrived. So what's changed for you in the last couple of months?
Yeah. Well, there's a lot that's changed in the last few months, of course, with COVID-19 and the disruption and kind of how people work. But also, if you step back, our industry, the industry that we serve generally is, of course, not just investors and corporations, but we also serve the brokerage industry, how people have access to capital markets and manage their portfolio. So that industry has massively transformed in the last 5 years or so. It's gone through its own disruption. It's been disrupted by technology, by fintech companies. Some of them are actually participating in these events. But, let's say Robinhood is a poster child for the big disruptor in retail brokerage, changing the experience of how to actually invest and manage an investment portfolio and have access to stock investing. So all of that disruption has created a perfect landscape, kind of the perfect tailwind for SAY to disrupt our niche in the world of capital market, which is investor communication. There's tens of millions of new investors in this market, with the advent of robo-advisors that are actually transforming this landscape. There's plenty of new investors that are actually thinking about the business very differently. They don't really want to receive an old-fashioned, legal-oriented proxy statement. They want to be engaged in a different way. So these new investors are demanding for new technology. The business model is changing dramatically, with firms like Robinhood offering free commission. It put a ton of pressure on the incumbents, like Schwab and E-Trade and Fidelity and others, to actually match them. And as a result, it led to a lot of consolidation. With people losing a ton of revenue, they have to be more thoughtful about how to keep their customers and how to make the best of their clients. So our approach to disruption is actually to transform investor communication into a relationship management capability, a customer engagement capability. So we've been very lucky with kind of what the landscape gave us in the last 3-5 years. And that's why actually the company entered this space and wanted to disrupt investor communication. It happens to be not only a great time, but it's also a lucrative opportunity. And then more recently with COVID-19, one part of our portfolio of services, which is how to enable a management team at big corporations like Tesla or Microsoft or Intel, or even smaller cap like the Howard Hughes Corporation, how to have these management team engage differently with the investors, and the investors engage differently with those management team. Now, of course, nobody can go to an annual shareholder meeting. Berkshire Hathaway is the poster child for the most interesting shareholder meeting. Now, Warren Buffett is not going to host the meeting in person; it's going to be webcasted. So yes, of course, technology like what we're using right now, Mark, you and I, with webcasting is really good, and it allows people to really understand and communicate with one another. But what about if you have 10 million shareholders? How are you going to actually enable these 10 million shareholders to ask questions and engage with what's happening with your strategy, with your crisis response, or any other part of your sort of corporate responsibility objectives? There's no real way to actually ask questions in a chat like what we see you and I in this current platform. The best way to do that is to have a completely different paradigm. So we've created a technology platform that allow more of a community orientation for shareholders to, as a group, millions potentially of shareholders can ask questions to Elon Musk or the CEO at Tesla or Intel, and Microsoft or Intel. And then these questions are viewed and by other investors. They can be supported. People can vote their own shares towards supporting another question. And invariably what happens is that the most interesting part of the shareholder meeting, the Q&A section of the shareholder meeting, the most interesting question are raised to the top. And it allows for a productive dialogue. So that's what we do at SAY. We were definitely handed a bit of a lucky strike with this COVID-19, which has been traumatic for so many people. But for SAY, it actually provides a demand for these corporations to be more thoughtful and more innovative about how they engage. So, luck has always plays a role in business. It's a matter of what you do with it. So we feel quite fortunate in that way.
Well, the more I practice, the luckier I get, or better lucky than smart, but better lucky and smart. But I think it's important. I mean, we'd had this conversation before, back in the old days of face to face. I remember you telling me that, even before COVID was considered a Western world issue, I think Tesla were using those kinds of facilities, and driving the questioning through that kind of platform. Elon Musk is known as a bit of a maverick and doing things differently. Maybe you can kind of expand a little on some of that.
Yeah. Well, I mean, Elon is the ultimate disruptor. He's disrupted so many industries, and his mindset is thinking about how to think outside of the box. So, the reason why we've partnered with Elon and Tesla in the launch of this service is actually because he wanted to disrupt the dialogue between shareholders and himself and his team. He didn't really necessarily only want to have the voice of the sell-side analyst community raise questions and sort of steer the topic and the engagement on the earnings call or the shareholder meeting. He wanted investors to be able to engage directly. So now that's even better in the world of COVID-19, when we're in the middle of what we call proxy season, which is where most of the annual shareholder meeting, over 60% of the annual shareholder meeting are going to take place in the next quarter and a half or so. So you need to find a way to engage with your shareholder. Otherwise, they're going to feel that their voice is somewhat lost. So we think we can help with that. By the way, as a way to support the industry, it's an old trick, but we think it's quite supportive. Is actually we're making our service for this Q&A part of our platform, which is called Say Connect, making our service available for free to public companies so they can manage this particular situation a bit more elegantly and a little bit more easily with their shareholders.
Okay, interesting. And as we're talking to our portfolio companies, and where, obviously there's a sort of a triage period of kind of understanding what runway is. I think we're in good shape there. There's a a stark reality window, which is, there's a probably maybe not for an organization in your space, but there's a lot of organizations that won't be making purchase decisions in the next 3 months while they get used to the new normal. And then there's the question of what you forecast after that, right? And again, we have things in our portfolio where the forecasts are being revised down. We have things in our portfolio where actually the forecasts are being revised up, because this environmental change, we're never going back to the full definition of the old normal, in my view. How are you thinking about your 24-month forecast for where this is going on the back of this wave?
Yeah, well, that's a good question. I mean, first of all, I should say we've taken a view of being always quite conservative with respect to how we manage our cash. So we do a ton of work with a small group of people. We're very fortunate. We're super talented people, let's say, that are enormously productive, even working remotely. So as a result, we have a pretty low burn. Our net burn is really manageable, and we still have plenty of cash on the balance sheet. So, if we were getting close to the end of our runway and it was time to raise money right now, where there's so much disruption and nobody knows exactly what the valuation world is going to look like and how people are going to deploy capital, would be pretty scary. So we're quite fortunate that way. The other part is how to think about revenues in 2020 and 2021. Nobody has a crystal ball. We all know that people are being distracted. Decision process are disrupted. It's hard to tell whether or not people are going to make purchase decision as fast. So we have to balance that with the fact that our products is a bit more in demand right now. One part of our business is really easier to understand because it actually relies on how active people are in the investment world. So, I've talked to a few of our retail broker clients. It's actually quite insane, the trend in the last 6+ weeks. The massive uptick in account opening, massive uptick in position taking. A lot of people, of course, are trading their accounts. They're going in and out, and they're trying to take advantage of these big pricing swings. But also, there's a lot of new investors that are just putting on long position because they've been effectively shopping a stock market on sale for the last 6 weeks. Yep. So our customers have grown a lot. One of our clients has doubled in their position in the last 5 weeks, and in the last 10 days, they're already gone by 20%, growth. So I don't want to generalize that this is going to go on all year, but this is definitely kind of securing our forecast for 2020.
Yeah.
Actually, I think it's likely we're going to beat it, but it's it's maybe a bit too early to say. But I'm sure a lot of other companies are struggling with that question because if we deal with a relatively long sales cycle for the broker side of our business, so we are comfortable with the fact that it takes time to get people to make decisions, but a lot of other fintechs at relatively short sales cycle, I think, is going to be tougher to predict revenues for them.
Yeah. Well, I'm going to pass that on to my deal team and hope there are no other venture capitalists in the audience. I can't see if we've got an audience of VCs or an audience of peers. So let's hope no VCs. You may have a slightly different view of that.
Well, but actually, I would turn the question over to you, Mark, because you've been investing for a while. You've also been on the operating side of the world, building companies and businesses. When you, as a venture investor, how do you see this new world, the deployment of capital? How are you going to make choices? Of course, you have your portfolio company that you need to look at. Also, you're looking at new investment. So what's your take on what's going on and how are you going to adapt?
That's a good question. I think there's a couple of different angles of answering that. So I think firstly the job for any VC has got to be like triage of the existing portfolio, right? Have you got problems or have you not? And you need to understand that. I think in that sense, speaking for ourselves, we're quite fortunate. We invest in enterprise fintech. It's not fickle consumer stuff. It's not travel and leisure. A lot of what we are invested in, much as with Say, I think it will be proven out to be very valuable in the in the medium term, even if very, very short term some of the wheels slip. So you get that out of the way. In venture, you are in the risk on business. So, we are very definitely still progressing deals that we have. We know who our top 3 targets are for fund for the next companies of fund 2, and I would expect to end up executing on somewhere between 1 and 2 of those, if not 3, and that's just the normal sort of distribution function in terms of probability. We are hearing some pretty abhorrent behavior in terms of sort of people pulling terms at the last minute, slashing valuations overnight on signed term sheets. And again, I think some of that is valid. There is a clear readjustment of value, but the ways in which some of that has been done in very aggressive predatory behavior, this is the stuff that destroys reputations. And venture is not a 3-month business; it's a 10 years, 10 years to a lifetime business. So quite interesting to see perhaps some of the short-termism around some of that. I guess the best way I can kind of illustrate it is coming into March, we had 4 external fundraisings in mid flow on the 11 companies we have remaining in Fund 1, and I was saying to my team that could end up as being 0, 1, 2, 3, or 4 deals. It's not, and the smart money might have been closer to 0 than to 4. As of last weekend, we closed 2 of those, and the other 2 are still in flight. So, the markets seem to be, functioning, reasonably well and intelligently, and people, understand that this is a longer game than the 3 months or 12 months or 18 months that we're kind of facing with the current scenario.
Yeah, and actually the reality is we don't know, how long people are going to feel nervous about investing. I was in 2000 when the .com bubble bursted. I was running a company that I'd founded called Prescient Markets. We were fortunate enough we had done our Series A a few months before. Yep. Actually, the market just went down 30%. NASDAQ went down 35% in April of 2000. But everybody took sort of everything off the table, and the only way to get money raised was at dismal valuation, because there was no real sense of where rebasing of valuation would be. Yep. I seen it also in 2008. I wonder here how that's gonna be. And at this juncture for say, we're thinking our business is doing really well. The fundamentals of our business have actually improved with the crisis. I wouldn't mind raising a bit more capital, because what's happening in crises is the big opportunity is talent, is to be able to bring the right people, smart people with good experience to good companies, and to do that sometimes you need capital. So it'd be nice to have some powder to be able to really build up our team a little bit more. We are sub 20 people, so we're running thin. But that's how I'm thinking about kind of the world right now. If the capital market is not so tough on valuation, it'd be great to raise a bit more money so that we can build up the company faster, given the tailwind we have.
I think that's very much in line with the advice that we're giving our companies, right? I mean, take more capital than you otherwise would do. Even if it's more dilutory, and that's not us saying take our capital. That's saying, if there is external capital, we'll ordinarily do our part. But having more runway in this amount of volatility is not a bad thing, right? I've seen a lot of papers kind of put out about how the funding landscape changed on the last crisis, but don't forget the last crisis was a financially led crisis, right? I don't think that we're going to see a incredibly rapid V-shaped recovery here. But at the same time, I think financial services are part of the solution to this problem, not the root underlying problem. So I don't think it necessarily, the funding landscape behaves exactly the same as it did last time. Although some compression of valuations, is inevitable. I would estimate. Well, I'm not seeing any further questions. I know that we're due to finish in 1 minute. Is there anything you'd like to say to wrap up, Laurent, before I close the session out?
No, listen. I think it's been this crisis has been so hard for everybody. I think it's created a ton of adjustment, a ton of anxiety. Some people have lost family members, friends. So we really hope this is going to be resolved in relatively quickly, and people are going to go back to normal. It does turn out sometimes to be an opportunity when there's a big dislocation and a change in behavior. So need to be able to take those and also acknowledge the fact that this is a tough environment. We do feel fortunate at SAY, and we're trying to help the industry and our customers as much as we can in this moment. But it was great to reconnect with you, Mark. Actually, after all these years.
There you go. It's a pleasure. Well, thank you for your time. Let me echo your sentiments on the human side of it. It's a very tough world out there, and it's also a tough world for those of us that have people in the non-financial market sector as well. So our thanks to everybody that's keeping the real world moving. Thank you for your time, Laurent. Thank you to the organisers, and we'll see you back in the main session.